Hello, my friends. Welcome. I want you to picture the year 1979. The New York Times published a quiet little story about Albert Einstein, and the author mentioned a rather beautiful, almost tragic little detail. The Rockefeller Foundation had once sent the great scientist a check in the mail for $1,500. Whether it was a donation or a grant, the exact reason is lost to time. But the brilliant physicist, lost in his own extraordinary mind, simply used the envelope with the check as a bookmark in the book he was reading at that very moment. And naturally, he lost it. He could never find it again. Today, a story like that feels almost impossible. We have banking apps glowing on our phones, plastic cards in our wallets, and we can send money across the country or across the oceans in a matter of seconds. But of course, it was not always this way. Who were the world's first bankers? Where did they sit? How did they guard their treasures? Could you send a wire transfer in ancient Rome or medieval Jerusalem? Tonight, we are going to explore all of this. Let us begin in the ancient world. The word bank did not even exist yet. In ancient Greece, if you needed financial help, you went to the bustling market squares, the agora. There, men sat behind wooden tables. In ancient Greek, a table was called a trapeza. And so these men were known as the trapezites. What exactly did they do? Well, at first they simply exchanged money. Imagine for a moment that you are a Greek merchant. You have traveled to Athens from Corinth. Your pockets are heavy with Corinthian silver, stamped with the image of Pegasus, the winged horse. But here in Athens, the merchants only want their own money, the silver coins bearing the profile of the goddess Athena and her wise owl. You need to exchange your money. And more importantly, the person taking your money needs to know it is real. So you go to the trapezite. The ancient world was a chaotic sea of currency. On the island of Aegina, they minted coins with a turtle. From the colonies on the Black Sea came coins bearing a griffin. Merchants from Asia Minor carried gold stamped with a royal archer. Athens was the beating heart of trade, and on any given day, the trapezites were drowning in work. How did they catch a fake? The banker had a special set of metal sticks, alloys of different compositions, and something called a Lydian stone, a touchstone. It was a smooth, dark block of dense flint. When a traveler handed over a coin, the banker would take it and scrape it hard against the stone. It left a bright streak. By comparing the color of that streak to his reference sticks, the banker knew exactly how much pure gold or silver was in the coin. They also used their ears. A banker would drop a coin onto his marble tabletop. Pure silver sings. It lets out a high, beautiful ring. But if the coin was hollow or laced with cheap copper, it landed with a dull, heavy thud. If a trapezite had a mountain of coins to check, he took a more brutal approach. He took a hammer and a chisel, and he struck the coin, leaving a deep gouge. If he saw the dull red gleam of copper inside, it was a forgery. Today we would look at a mutilated coin and think it was ruined. But in the ancient world, a chiseled coin was a beautiful thing. It meant someone had already tested it. It was trusted. Museums today are filled with ancient coins bearing these deep, violent cuts. By the 4th century BC, these men were doing far more than just checking silver. They began taking money for safekeeping. They acted as guarantors for massive trade deals, and naturally, they began lending money at interest. The most popular loans were for maritime expeditions. Sending a wooden ship across the dark, unpredictable sea was a terrifying risk. Storms could swallow a vessel whole. Pirates prowled the coastlines. Because the risk was so immense, the interest rates on these maritime loans were incredibly steep. And it was these ancient Greek bankers who gave us the concept of the mortgage. They called it hypotheca. Up until the 6th century BC, if a Greek citizen borrowed money, he put his land up as collateral. A heavy stone pillar, a debt stone, was driven into the earth at the edge of his property. It was a constant, looming reminder: this land is not truly yours until the debt is paid. If he failed to pay, the farmer didn't just lose his land, he was sold into slavery. Then came Solon, the great Athenian reformer. He ordered the debt stones smashed to dust and outlawed debt slavery forever. And from that mercy, the hypotheca was born, a far more humane system of pledging property. In the beginning, a young trapezite working in the open market didn't have much. At sunset, he simply swept his coins and his touchstones into a heavy leather sack and walked home, flanked by guards. But the master bankers, the men dealing in chests of gold and mountains of silver, could not operate in the open air. It was too dangerous. They began renting buildings right on the edge of the market. They still called it a trapeza, but these were the world's first true bank branches. Naturally, desperate men tried to rob them, and so the Greeks engineered formidable defenses. At the entrance, they chained massive, vicious dogs that would wake the neighborhood at the sound of a footstep. Inside, in the dark, armed slaves slept near the vaults, gripping short swords and heavy wooden clubs. The law was entirely on the banker's side. If a thief broke in under the cover of night, the slaves were legally permitted to kill him on the spot. It was simply defense of property. On the other hand, if a slave fell asleep and allowed a robbery to happen, he faced a brutal, agonizing execution. The motivation, as you can imagine, was absolute. The vaults themselves were fortresses. They were built in cellars with no windows, or perhaps just a sliver of a slit near the ceiling. The doors were carved from ancient oak, layered with iron, secured by multiple heavy locks. The silver was kept in massive chests, reinforced with forged iron bands. A full chest weighed hundreds of pounds. You could not simply pick it up and run. The most precious items, the gold and the vital debt contracts, were hidden in deep stone pits, carved directly into the floor, sealed beneath a massive slab of rock. They called these hidden vaults a lakos. Even if the building burned to the ground, the lakos remained untouched. But if you had wealth that defied imagination, you didn't trust a building. You trusted the gods. You took your gold to the grand temples. In ancient Greece, no one dared rob a temple. To steal from the sanctuary of Artemis in Ephesus or Apollo in Delphi was to steal directly from the divine. It was the ultimate crime. And so the great temples functioned as the safest bank vaults on earth. Our wealthy Athenian banker likely kept his deepest reserves high on the hill in the Parthenon, under the watchful eye of Athena. In the year 146 BC, the Roman legions conquered Greece. And as they did with so much of Greek culture, the Romans absorbed the banking system. They called their private bankers argentarii, drawn from the Latin word for silver. The argentarii did what the Greeks did, but with a uniquely Roman obsession for order. They changed money they issued loans, but above all they kept impossibly meticulous records. A Roman banker's ledger was considered absolute legal truth. In a Roman court, those books were standalone evidence. They required no witnesses. With that power came a terrifying responsibility. A banker's book could not contain a single error. A crossed out line, a smudge, an alteration, these were considered crimes against the state. To avoid this, the bankers did their daily math on a counting board, an abacus, moving pebbles to calculate the sums. Their record keeping was a two-step dance. During the chaos of the day, every transaction was scratched into wax tablets with a stylus. Money in, money out. These were rough drafts. Mistakes were allowed here. Then, once a month, in the quiet of the evening, those wax scribbles were carefully transcribed into the master ledger. At first, these ledgers were unwieldy papyrus scrolls. Imagine trying to find a single transaction from a Tuesday in March, unrolling 20 feet of fragile paper. It was maddening. By the twilight of the Roman Empire, they began cutting the papyrus into pages and binding them. The birth of the book. It changed everything. Their entries were cold and beautiful in their brevity. The client's name, the sum, the date, and the reason for the payment. The Romans revered stability, so alongside private bankers, they created state bankers. Like the Greeks, they originally sat at tables in the forum. The Latin word for table was mensa, so these men were the mensarii. But they didn't work every day. They only appeared during times of war or catastrophic financial panic. They handed out low-interest government loans to save citizens from ruin, preventing the collapse of the city's economy. By the 2nd century AD, the Roman Empire was a leviathan. It stretched from the Atlantic shores of Portugal to the deserts of Mesopotamia, from the cold rains of Scotland to the blazing sun of Egypt. Moving physical chests of silver across this vast, dangerous map was madness. And so the Romans engineered a system of cashless payments. We know exactly how it worked, thanks to the letters of the great philosopher and statesman Cicero. In the spring of 45 BC, Cicero wrote to his dear friend, a banker named Atticus. Cicero's son was heading off to university in Athens. The boy needed an allowance of 100,000 sesterces. In physical coins, that is a crushing weight of silver. Sending a boy on a ship with that much treasure was an invitation to pirates. So Atticus arranged a beautiful illusion. He had a client in Athens who owed him money. He sent word to that client, "Do not pay me in Rome. Instead, give the silver to Cicero's son when he arrives." Meanwhile, Cicero handed his silver over to Atticus in Rome. The wealth teleported across the sea, without a single coin ever touching a ship's deck. Cicero called it permutatio, an exchange. It was the ancestor of the wire transfer. The Romans even began selling debts. If you owed a banker money, they would draw up a formal contract, witnessed and sealed in wax. That banker could then sell your contract to someone else. Suddenly, you owed your silver to a stranger. It was the dawn of the financial market. But then Rome fell, and as the aqueducts crumbled, and the roads faded into the grass, banking in Europe simply vanished. The unified law that held the system together evaporated. The world retreated behind the high stone walls of feudal castles. The economy became brutally local. Peasants grew wheat and raised cattle on their lord's land, paying him with grain. They ground their flour at his mill, wove their clothes from their own sheep. It was a life of quiet survival, built entirely on barter. Coins became a mythical rarity, and without trade, without coins, bankers are nothing but ghosts. There was another deeper reason. In the rising Christian culture of the Dark Ages, lending money for profit was considered a mortal sin. At the Council of Nicaea in the year 325, priests were strictly forbidden from taking interest. Soon, the ban fell upon everyone. A good Christian was expected to help his neighbor out of love, not for profit. Furthermore, theologians argued that charging interest was literally selling time. And time, they declared, belonged only to God. To sell it was blasphemy. Europe would sleep in this financial darkness for 700 years. The awakening came in the year 1099, following the blood and dust of the First Crusade. Christian knights had captured Jerusalem, and a river of pilgrims began flowing from Europe toward the holy sites. But the roads were terrifying, crawling with bandits and thieves. To protect these travelers, a small band of French knights took a vow. They called themselves the Poor Fellow Soldiers of Christ and of the Temple of Solomon. History remembers them simply as the Knights Templar. They grew rapidly, and soon these warrior monks became the undisputed bankers of the Middle Ages. Their mission was simple: keep the pilgrims alive and keep their wealth safe. It worked like magic. A wealthy traveler would walk into the Templar fortress in Paris or London and hand over a heavy bag of gold. In return, the silent knights handed him a small piece of parchment. The traveler rode across the perilous world with nothing but paper. When he reached Jerusalem, he handed that parchment to the local Templars, and they handed him his gold in local currency. To ensure the system wasn't compromised, the Templars invented a brilliant cryptographic cipher based on the points of an 8-pointed cross. To an illiterate bandit, the parchment looked like a madman's drawing of strange angles, squares, and dots. To prevent forgery, they used a double seal, one heavy stamp of wax on the outside, and a second hidden seal inside the folded parchment. And yes, the Templars offered loans. But wait, you might ask, what about the Church's absolute ban on usury? The Templars were clever. They didn't charge quote-unquote interest. Instead, a noble taking a loan would hand over the deed to his estate as temporary collateral. The Templars would simply manage the land and keep every ounce of profit from the harvests and rents until the loan was paid. It was interest by another name. If the noble died or defaulted, the castle belonged to the Templars. By the middle of the 12th century, the Templars were the wealthiest corporation on earth. They owned 9,000 estates from the cliffs of England to the shores of Portugal. They owned entire fleets of ships, whole villages, sprawling farms. The great irony was that every individual knight had taken a vow of absolute poverty. They owned nothing, but the order owned the world. Their financial genius made them the treasurers of kings. The French crown kept its royal wealth inside the Templar fortress in Paris. But that immense power was a fatal trap. King Philip IV of France, a man drowning in debt to the order, owing them a staggering 500,000 livres, decided to erase his ledger with blood. On a Friday the 13th, he ordered the sudden mass arrest of the Templars across France. The leadership was destroyed. 5 years later, the Pope dissolved the order forever. With the Crusades fading, the Mediterranean Sea woke up again as the great highway of the world. The power shifted to the glittering Italian port cities, Venice and Genoa. Here in the warmth of the Renaissance, banking was reborn. International trade simply cannot breathe without credit and bills of exchange. But Italy had another advantage. Hidden in their libraries were the ancient preserved texts of Roman law. Written in clear Latin, these codes gave Italian lawyers the philosophical foundation to justify complex contracts, documents that the rest of superstitious Europe still viewed as dark magic. Imagine Venice in the 15th century. You are walking near the Rialto Bridge. In the bustling square, men sit on long wooden benches. Before them are tables draped in heavy green cloth, designed to keep coins from rolling away. In Italian, that wooden bench was called a banco. That is where we get the word bank. And if a banker played loose with the rules, if he lost the people's money, the city guards would drag him to the square and physically smash his wooden bench to splinters with an axe. Banca rota, a broken bench, the birth of the word bankrupt. From that day on, he was banished from the financial world. It might sound simple, just set up a table and collect silver, but it was a closed elite world. To be a banker, you had to be accepted into the powerful guilds. You had to prove legitimate birth, possess a flawless reputation, demonstrate mastery of the abacus, write with elegant precision, and know the exact metallurgy of foreign coins. You also had to pay a massive fortune just to join. Even then, the city heavily regulated the number of benches on the square. A spot on the Rialto was passed down from father to son like a crown jewel. And crucially, you had to prove you had your own capital locked in the guild's vault. If you failed, your personal wealth was given to the victims. Over time, the industry split. The men sitting out in the weather on the benches were called camp sores. They were the money changers. They dealt in the chaotic physical reality of Venetian ducats, French écus, German gulden, and Arab dinars. They were the frontline defense against the tsunami of counterfeit coins. A camp sore always had a delicate apothecary scale on his green cloth. Every single coin was weighed. If a coin was missing even a fraction of a gram of gold, it was rejected. They made their living entirely on the subtle margins between buying and selling. They didn't offer loans. They just provided the oxygen of clean money to the market. The true titans, the men who moved empires, were the banchieri. They didn't sit in the rain. They operated out of massive 3-story stone mansions called palazzos. The most famous of them all, of course, were the Medici. Let us step inside their world in Florence. By the mid-15th century, they built the breathtaking Palazzo Medici Riccardi. For generations, this building was the blueprint for what a bank should be. The ground floor was the engine room. Imagine the smell of iron gall ink, sealing wax, and old parchment. Clerks sat at long wooden tables. Along the walls stood massive wooden cabinets holding giant leather-bound folios. This was the 15th century equivalent of a server farm, the data center of the Renaissance. The second floor was a world of velvet and silence. The reception halls. Here, the Medici hosted kings, cardinals, and ambassadors. Wars were funded here. Peace treaties were bought here. Politics and credit were braided together so tightly you couldn't pull them apart. The third floor was where the family actually lived, and deep below the earth in the cold cellars lay the vault. Iron chests bolted directly into the stone floors, built into the heavy masonry. From the street, the palazzo looked almost austere. The lower level was clad in rough, unpolished stone, making it look like a medieval fortress. The upper floors were elegant but remarkably restrained. No gold leaf, no screaming displays of wealth. The Medici understood a profound truth captured in a family proverb. Envy is a weed that should not be watered. Let's talk about those vaults. In ancient Greece, as we saw, vaults were guarded by men with swords. In Renaissance Florence, the defense was mechanical. The bankers relied on the legendary Nuremberg chests. The blacksmiths of Nuremberg were the undisputed masters of ironwork in Europe. These chests were terrifyingly complex. A hollow box of thick oak, wrapped in a grid of forged iron bands, weighing hundreds of pounds, before a single coin was placed inside. But the true genius was in the deception. You might look at the lid and see no keyhole at all. To reveal it, you had to press a hidden iron pedal in a decorative flower, or slide a secret panel. Sometimes they built false keyholes right on the front. If a thief slid a lockpick into the fake hole, a fragile internal pin would snap, permanently jamming the entire mechanism. The only way in after that was days of agonizing, noisy sawing. The real locks were marvels. Turning one key would trigger 15 different steel latches to slide under the rim simultaneously. And the keys themselves, they were not simple jagged teeth. The grooves were carved into 3-dimensional labyrinths. You could not make a wax mold of a Nuremberg key because the wax couldn't capture the varying depths of the maze. These keys were massive, a foot long, weighing nearly 2 pounds. The bankers wore them on heavy chains from their belts. It was the ultimate status symbol. As the centuries turned, the world's gravity shifted. Ships found the sea route to India, and the wealth of the world moved from the Mediterranean to the cold gray waters of the Atlantic. The Dutch took the stage. The Dutch did something revolutionary. They took banking out of the shadowy, secretive family palazzos and turned it into a transparent public institution. The Italian families kept secret ledgers books that chronicled the true hidden debts of popes and monarchs. The Dutch decided that trust required light. In 1609, they created the Bank of Amsterdam, the Wissel Bank. It was the world's first central exchange. You could bring any chaotic, clipped foreign coin to the bank. The clerks would weigh it, melt it down in their minds, and calculate its exact pure metal value. And then they did something magical. They credited your account with a newly invented, entirely virtual currency, the bank florin. A physical florin was a gold coin from Florence. But the bank florin existed only as ink in the ledgers of Amsterdam. It was purely digital centuries before computers. And because the bank guaranteed its value, this invisible money became the most stable, trusted currency on Earth. Merchants from across the globe refused to trade in physical silver. They only wanted ledgers shifted in the Bank of Amsterdam. The bank sat in the left wing of the Grand City Hall. Down in the deep, vaulted basements lay a vault totally isolated from the outside world. It ran with the precision of a clock. A merchant would step up to a wooden counter, hand over a paper order, and a clerk with a long quill would scratch the transfer into a leather book. Down below, the silver lay in massive, shared bins, though the wealthiest clients rented their own heavy chests, sealed with red wax and multiple locks. The city watch, professional soldiers, armed with halberds, walked the stone corridors day and night. Their standing orders were absolute. If a stranger is found in the vault, do not ask questions. Shoot to kill. The Bank of Amsterdam was strictly a depository bank. That meant one simple thing. They were forbidden from lending money out. They made their wealth purely on tiny storage and transfer fees. And because of this, the public trusted them with a religious fervor. Everyone believed that for every virtual florin written in a book, a physical piece of silver lay sleeping in the dark below. The belief was that if every client walked in on the same day and demanded their money, the bank could pay out every last cent. This bank fueled the Amsterdam Stock Exchange, the first open securities market in history. The Dutch East India Company was born, funding massive fleets to the edge of the world. Citizens bought shares, and the money flowed through the Wissel Bank. It was a perfect closed ecosystem of absolute trust. Amsterdam became the center of the world. For nearly 200 years, their reputation was flawless. No one knew that in the shadows, the directors were breaking their own golden rule. Starting around 1657, the bank began secretly lending money to the Dutch East India Company. It made a strange kind of sense. The company wasn't just a business. It was the armed wing of the Dutch state. It fought wars. It built colonies. It made the citizens incredibly rich. They needed capital. So the bankers quietly reached into the sacred vaults. But by the late 18th century, the East India Company was bleeding. Wars with the British and rampant corruption were tearing it apart. The company began defaulting on its secret loans. To hide the black hole in their vaults, the bank began cooking the books. On paper, the silver was there. In reality, millions of florins were simply gone. Ghost money. Whispers began to spread in the taverns and the docks. The bank couldn't silence them. In 1790, the whispers became a roar. A panic set in. Wealthy merchants rushed the counters demanding their physical gold. The bank hesitated. They introduced delays, limits on withdrawals. It was a death sentence. Trust is a mirror. Once shattered, it cannot be put back together. When the auditors finally breached the vaults, they found them shockingly empty. More than 10 million florins had been lent out and lost to the sea. 2 centuries of immaculate reputation evaporated in a matter of weeks. The virtual florin collapsed. When Napoleon's troops marched into the Netherlands a few years later, they found an empty shell. The legendary bank was quietly liquidated. Across the Channel, a new empire was rising. The British had broken the Dutch on the seas, and with them, the global economy shifted to London. But the British economy was volatile. Out of the chaos, 2 massive financial dynasties emerged, the Barings and Hope and Company. The Barings started out trading wool before moving into colonial sugar, cotton, and tea. The Hopes traded spices and silver out of Amsterdam. These families were titans. They owned the ships. They owned the warehouses. They controlled the entire nervous system of global trade. They became so powerful that smaller merchants began coming to them for a different kind of favor. "Put your signature on my paper," a merchant would ask, "so that when my ship docks in Lisbon, they will give me the goods on credit." Barings and Hope realized something profound. Moving heavy physical cargo across oceans is dangerous. Ships sink. Moving a piece of paper with your name on it, that is pure profit. They built a global network of merchant banks. They issued acceptances, a guarantee that the bank would cover the trade. A piece of paper bearing the signature of the Baring brothers became as good as physical gold anywhere on the planet. By the late 18th century, these banks were the silent architects of geopolitics. When the United States wanted to buy the Louisiana Territory from France in 1803, effectively doubling the size of the young nation, where did they get the money? The Barings bankrolled the transaction. By the 19th century, the great bankers realized that the ultimate currency wasn't gold and it wasn't silver. It was information. The winner wasn't the man with the thickest vault doors. It was the man who knew the news before anyone else. This was the genius of the Rothschild family. Mayer Amschel Rothschild sent his 5 sons to the financial capitals of Europe: London, Paris, Frankfurt, Vienna, and Naples. They built a private intelligence network that was terrifying in its speed. Their couriers waited at the docks of the English Channel, carrying financial news that reached the London office a full 24 hours before the British government or the markets knew a thing. Let us take a step back and look at the physical money itself. For centuries, we carried heavy metal, but eventually the world transitioned to paper. Metal was stable, but it was an agonizing burden. Imagine being a farmer in the 18th century. Your entire life savings might be in heavy copper coins. Carrying the equivalent of a few dollars meant lugging a sack that weighed 20 pounds. The story of the first true paper banknotes in Europe brings us to a man named Johann Palmstruch. He was the director of the Bank of Stockholm. In 17th century Sweden, the currency was the copper daler. And these were not coins, they were massive slabs of metal. The highest denomination weighed over 40 pounds. In 1660, the Swedish government decided to mint new copper coins that were lighter but supposedly worth the same amount. Naturally, the citizens panicked. They rushed the bank to withdraw the old heavy coins, knowing the raw metal was worth more. To stop the bleeding, Palmstruch had an idea. "Leave the heavy copper in the vault," he told them, "and take this piece of paper instead." On a summer day in 1661, the bank issued the world's first modern banknotes. They paid no interest, but they could be handed from one person to another to settle debts. Each note was signed by hand by the bank's directors and stamped with red wax seals. It was brilliant, but Palmstruck soon realized a dangerous truth. The people in the street couldn't see into the vault. He could print more paper than he had copper. And so he did. The market flooded with paper. Inflation took hold. The bank refused to exchange the notes for metal, and the system collapsed. Palmstruck was thrown into prison for his financial alchemy. But the idea was too good to die. Paper was light. Paper was the future. Soon England and Scotland adopted it. But the banks learned a lesson. The paper had to be backed by something real. You had to be able to walk into a bank, hand them a piece of paper, and demand physical gold. This promise, the gold standard, held the world together for a century and a half. But the devastation of the Second World War left the global economy trembling. The world was on the brink of ruin. And so, deep in the woods of New Hampshire at the Bretton Woods Conference, a revolutionary agreement was struck. The world's currencies would no longer be tied directly to gold. Instead, they would be tied to the American dollar. And the dollar alone would be tied to gold, locked at a fixed price of $35 for a troy ounce. It made the American dollar the undisputed king of the global economy. But history has a rhythm, and America eventually made the same mistake as the Bank of Stockholm. By the 1970s, the world looked at the mountain of dollars flooding the globe and realized there was simply not enough gold in Fort Knox to back it all up. Nations began demanding their gold. In 1971, President Richard Nixon went on television and simply severed the tie. He closed the gold window. It became known as the Nixon Shock. From that day forward, the world has operated on fiat money. Money that has value simply because the government says it does. It is backed by nothing but faith, trust, and the shadow of the state. But banks do not just hold money. They hold the future. They hold stocks. The concept was born back in Amsterdam with the Dutch East India Company. Instead of one man risking his entire fortune on a dangerous voyage to Indonesia, thousands of citizens could buy a tiny fraction of the ship. If it returned full of spices, they shared the dividends. They traded these paper shares in the open air of the Amsterdam Exchange. But for a long time, stocks were seen merely as a way for a company to borrow money. Everything shifted in the mid-19th century, particularly in Britain. Laws were passed that legally recognized stocks as movable personal property. You could bequeath them to your children. You could sell them like a piece of furniture or a tract of land. Investment banking was born. Bankers realized they didn't just have to hold money. They could buy pieces of growing companies, wait, and sell them at a massive profit. Trading securities became the true engine of Wall Street. Then came the machines. In the years following the Second World War, the American middle class exploded. Everyone was buying cars, televisions, homes, and they were paying for it all with paper checks. The banks were literally drowning in paper. Tellers were closing the doors of the bank at 2 in the afternoon just so they could spend the rest of the night manually recording the day's checks into ledgers. It was unsustainable. In the 1950s, Bank of America partnered with the Stanford Research Institute to build a mechanical savior. They called it IRMA, the Electronic Recording Machine Accounting. Built by General Electric, it looked nothing like a modern computer. It was a humming, clanking beast that filled entire rooms. You fed bundles of paper checks into a scanner. IRMA read the account numbers, checked the balances, and processed the math. A brilliant human accountant could process maybe 250 checks an hour. IRMA processed 550 checks a minute. It was a revolution. And from there, the leap to plastic was inevitable. The legend goes that a businessman named Frank McNamara was having dinner at a restaurant in New York. When the bill arrived, he reached into his pocket and realized he had left his wallet at home. The sheer embarrassment of that moment sparked an idea. What if there was a little cardboard card that proved who you were, allowing you to sign for your meal and pay the combined bill at the end of the month? He launched the Diners Club. It caught fire. Soon after, Franklin National Bank issued a true bank card. Bank of America launched the Bank AmeriCard, which you now know as Visa. American Express introduced the first card made of plastic. Throughout all of this history, the bank was never just a vault. From the Roman Forum to the Italian palazzos, bankers were always reaching for the absolute edge of technology. They were building the first ecosystems. Recently, I sat down with an executive, a true pioneer in the modern digital banking world, a man who helped build one of the first truly branchless digital-first banking platforms. We talked about how the industry has shape-shifted over the last 20 years. He pointed out something rather profound. For decades, America has led the world in innovation. We gave the world the microchip, the moon landing, the internet. But in the world of consumer finance, the evolution was sometimes slow. We suffered from what economists call the paradox of the latecomer. Sometimes, when a country has a massive established infrastructure, like millions of old magnetic stripe card readers, they are slow to change. Meanwhile, newer markets skipped the old tech entirely, jumping straight to contactless chips and mobile wallets. But over the last 2 decades, the fintech revolution leveled the playing field. He reminded me of how painful banking used to be. Remember the old joke, he said? Wherever you opened your account, that's the branch you have to go to close it. Today, that feels like ancient history. The entire paradigm has shattered. Payments across the country are instantaneous and free. Why should anyone pay a fee just to rearrange digital numbers on a screen? In the Middle Ages, you paid a knight to ride across Europe with a chest of gold. Today, there is no knight. The data just flows. Credit is granted in milliseconds. Years ago, regulators would walk into a bank and demand to see the physical files. A bank would have to point to a room stacked to the ceiling with thousands of pounds of paper. Today, an algorithm analyzes 1 million data points in the time it takes you to blink. I asked him about the younger generation, the Zoomers. What does a bank mean to someone who is 20 years old today? To my generation, a bank was a fortress of stability. It was the heavy marble columns. It was knowing the branch manager's name. But to the new generation, a bank is just another app on their phone. It sits right next to their streaming music and their social media. They don't care about marble. They care about friction. They care about design. They assume the security is flawless because they already trust their phones with their deepest secrets, their private messages, their entire lives. To them, finance has to be gamified. It has to feel alive. We talked about how banks today compete on emotion. They issue heavy, cool metal credit cards that make a satisfying clack when you drop them on a restaurant table. They design apps that shoot off digital fireworks when your paycheck hits your account. And then there is artificial intelligence. It is no longer science fiction. It is the quiet voice in the machine. Years ago, chatbots were infuriating. People just typed agent over and over until a human arrived. But today, the AI knows your entire financial history. If you ask it to generate a complex tax document for an embassy visa, it does it instantly. It can read the earnings reports of major tech companies and summarize them for your portfolio. The algorithms are catching our mistakes before we even make them. If you type the wrong PIN at an ATM, before you can even panic, your phone buzzes with a push notification, softly suggesting, "Having trouble? Tap here to securely view your PIN." It is the architecture of a frictionless life. But it makes you wonder if every bank eventually offers the same instant transfers, the same zero fees, the same AI chatbots. How do they survive? What is the future of the bank? My friend had a fascinating answer. He believes that in the future, banks will split into two paths. The first path is invisibility. The bank will sink entirely into the back end. It will become pure infrastructure. When you tell your smart home to order groceries, you won't think about the bank processing the payment. It will just happen, silently optimizing your rewards in the dark. But the second path is partnership. Right now, a bank makes its money off your debts. But what if a bank's ultimate goal was to increase your, quote, lifetime value as a human being? They have the data. They know what career moves pay off. They know when a loan will build your business and when a loan will crush you. Imagine a bank that acts like a shareholder in your life. An institution that says, we are going to give you the education, the capital, and the insights to double your net worth over the next 10 years. And in return, we will take a tiny fraction of that success. It is the ultimate alignment of interests. The bank only wins if you thrive. We have come a long way. From a man sitting on a wooden bench in a dusty Greek market weighing silver coins on a scale, to an invisible intelligence resting quietly in the palm of your hand. For centuries, a bank was the most serious, somber place on earth. Men in dark suits whispering behind thick glass. Today, it is an ecosystem of emotion, of design, of invisible power. They have taken the trust built over 1,000 years and wrapped it in the technology of tomorrow. But strip away the marble, strip away the iron chests, strip away the glowing screens, and what remains? It is the exact same thing it was on the Agora. It is people. It is the ambition of the merchant, the hopes of the traveler, the quiet desire to build a better life for tomorrow. My friends, as we reach the end of our time tonight, I want to mention that we have touched on a few stories we have explored deeply in the past. If you found yourself wondering about the streets of the Roman Empire, the secrets of the Knights Templar, the ships of the Hanseatic League, or the shadowed halls of the Medici, I invite you to seek out those episodes in our archives. I want to thank you for sitting with me tonight, for listening to the long, slow story of our world. If you find a quiet joy in these journeys, I softly ask that you subscribe to our channel. Tap the bell so that we might find ourselves together again on another quiet night. Take care of yourselves, and good night.